Hello and welcome to Cafe Mutual YouTube channel. Friends, any economy goes through phases, and each phase has a certain impact on sectors. But what if I tell you that there is a fund which will identify economic cycles well in advance and take positions accordingly to grow your wealth? Yes, there is a fund category called Business Cycle Fund which aims to do that. To talk more about the new category, today we have invited Nilay Dalal, Fund Manager, ITI Mutual Fund. Nilay has close to 15 years of experience in equity research and fund management. So, welcome to the show, Nilay.
Thank you. Thank you for the introduction. Hi.
Great, great, great. Nilay, my first question to you is that the last 1 year has been the period of heightened volatility in the equity markets. In fact, markets have delivered suboptimal returns during this period. So, in such a scenario, what can distributors expect from equity markets in the medium term?
Sure. So I think the period of volatility of the last year was sort of a necessary consolidation phase. According to us, this period has helped absorb a lot of the excess optimism, stretch valuations of sort of the previous years, effectively resetting the stage for a more fundamentally driven market in sort of the near future. There is a distinct transition from a momentum driven market to an earnings led market. And we believe that going forward, at least on the earnings trajectory, if you see with India's GDP sort of set to grow at 7.3 to 7.4% for this year, corporate profits are expected to see sort of mid to high teen growth in several sectors. In terms of valuation, also, if you look at it, a lot of the froth in the mid and small cap space has reduced, making valuations more reasonable. But we do believe that going forward, the right way in investment would be to selectively pick your sectors and selectively pick your stocks.
Great, great. So, Nilay, what is your view on the macroeconomic cycle of the Indian economy, and how do you see it impacting our equity markets?
Okay, so Indian economy, we would place it in the early to mid expansion phase. But this time there is a unique twist. We are witnessing a consumption-led pivot. So,
Hmm.
like I said, GDP is set to grow at that 7.3, 7.4%, but we are also seeing a handoff. The heavy lifting previously done by government capex is now being joined by revival in private consumption and also rural demand.
Hmm.
So the macro triggers are in place with inflation having moderated and the RBI having executed a rate cut of about 125 bips over the past year. We believe that the cost of money is now supportive of growth. Also, in terms of the suboptimal returns of 25, like we said earlier, served as a healthy de-risking event. Uh, in 2026, we believe that the impact on equities will be twofold. One is it would be about earnings rather than multiples. So market returns are no longer driven by stocks getting more expensive. But we believe that actual earnings will be more important. Earnings growth for 27, we project it to be pretty robust. Also, one more thing one has to note, the new regulatory guardrails by the RBI would sort of reduce market leverage. I think there would be a cooling down of speculative hot money in derivatives. While this might be a temporary dampened trading volumes, it actually creates a much steadier floor for long-term investors.
Okay, okay, great, Nilay. So, wanted to understand, Nilay, that your fund house has launched ITI Business Cycle Fund recently. So, what's the rationale for this launch at this point of time?
Okay, so at this point of time, for us, it is the end of momentum-based investing. It is also a start of sort of rotation-based investing. See, in the last few years, you saw broad-based rally, where almost everything sort of went up.
Hmm.
But as we are entering this new year and also the last year, the market is becoming more discerning. So
Hmm.
what last year showed us was that being in the wrong sector at the wrong time, even if the economy is sort of doing well, can lead to sort of suboptimal returns. This fund is being launched now because we are sort of entering a phase of high dispersion, where the gap between say a good performing sector and a bad performing sector will actually widen even further. Also, like I said, so we want to catch India's second wind. So India is currently moving from an sort of early expansion to a mid expansion phase in its own cycle. So we are seeing a transition from again your capex driven spending by the government to private capex. We are seeing a consumption recovery. A business cycle approach, according to us, allows us to stay agile, as in capturing the industrial boom, as well as sort of having a mandate to pivot to other sectors if necessary.
Okay. So, Nilay, but how do you determine which sectors are likely to benefit from a particular phase of economic cycle? And what happens if your analysis turns out to be incorrect?
Okay, so our approach is actually three-phased, as
Hmm.
in identify the right sort of sector cycle to invest in. So the first phase is obviously to analyze the overall macro cycle, which includes the global cycle, the country cycle, also the currency cycle, commodity cycle. Everything is sort of included in this overall macro analysis. That helps us to overall get an idea of what sectors would typically benefit from this sort of analysis. Again, the second phase of our study would relate to sectors. So we have predefined sectors to sort of analyze the sectoral cycle based also on the macro analysis. Having done this, we believe one of the most important phases in our sort of sector cycle identification is to also analyze the valuation cycle or sort of the market cycle. See, one thing is for sure, if you get the business cycle or the sector cycle right, but you are at the wrong end of the valuation cycle, uh, your call may go right, but you end up not making a lot of money. So for us, in both the cases, even if we are incorrect, say some of the time in identifying the sector cycle,
Okay.
because you will have sort of invested yourself in the sector at a fairish valuation, the downside sort of remains low.
Okay. So, as per your current analysis, which are the sectors you will be betting on?
No, so as we've sort of already given in our presentation, I think the sectors that we like currently are power,
Hmm.
including utilities, ancillaries. We believe they should sort of do well. We are also liking the healthcare space, especially the large hospital chains. According to us, the cycle is sort of in that early to mid expansion zone and should last for a long time. Also, we are looking at themes such as premiumization, financialization. According to us, themes are a basic sentiment change. And that is why they last actually much longer than the sector.
Okay. And what's your view on the technology sector? Will it offer a good opportunity to make an entry?
So I believe it will eventually offer a sort of a good opportunity. I mean, see, with the technology sector specifically, we believe current uncertainties outweigh the certainties. So
Hmm.
in such a scenario, I would believe it is difficult to take sort of a long-term view on the sector. So I think some clarity is needed.
Hmm.
What artificial intelligence can really do. Post which I think the sector could see a sort of proper movement.
Got it. Got it. So that brings me to my next question. Could you throw some lights on the entry and exit strategy of for stocks in your business cycle fund?
Okay, so for us, stock picking is sort of a very traditional approach. I mean, the sector cycle identification part of our analysis is mostly top down, but the eventual stock picking within the cycle, within a business cycle, is a pretty traditional approach. So we obviously do our quantitative research on stocks, but we are also sort of a big fan of the secondary research or sort of the qualitative research.
Hmm.
So for us, the touch feel of a company is extremely important. So we do a lot of secondary research, which helps us to sort of pick stocks within a cycle. But remember, business cycle is sort of the boss here. So
Hmm.
I would sort of analyze stocks within a cycle or a sector only if we believe it is in the right cycle. So that comes first. Obviously, beyond that, stock picking is a proper bottom-up approach. And like I said, it is quantitative as well as qualitative.
So, Neela, some MFDs say that business cycle funds and sector rotation funds are somewhat similar. What is your take on this?
No, so our view is pretty simple. We believe business cycle funds are a more holistic approach. So in the sense that it is a complete top-down approach wherein you analyze the macro cycle, which includes a global cycle as well as the country cycle. Within this macro analysis, you also sort of try to analyze overall consumption, your currency trends, your trade trends, uh, post which you sort of go to the identification of the sector cycle. Sector rotation funds, on the other hand, we believe are more tactical. They are more quantitative in nature. In terms of concentration, also what we believe is a sector rotation fund will be a much more concentrated and hence sort of relatively more risky to business cycle funds.
Okay, Neela, one last question. Why do you think MFDs should recommend ITI business cycle funds to their client?
Sure. So first and foremost, we believe that we are in a very attractive zone in terms of the market. So, like I said earlier, we have seen valuations sort of correct decently in the last 1.5 years. The froth, especially on the mid and small cap space, is mostly sort of behind us. We believe that it is the right time to sort of invest in the market from a longer term perspective. And our business cycle fund, first and foremost, we don't want to run it like a typical diversified fund, whether be it a flexi cap fund or a multi cap fund. We want to take that conviction calls on sectors. We will typically be abnormally high in terms of overall sectoral deviation. Um, and we have sort of a lot of confidence in our process of analysis of the business cycle.
So, all right, we have come to an end to this interesting discussion. Thank you so much, Neela, for your valuable time and inputs.
Thank you, Nisha.
And finally, I thank each one of you for being such a wonderful audience. Have a great day at work, guys. Bye.